Computing returns on foreign investments. When investor invests in other country other than home country, then the investor bear additional risk to the expected return on investment, which is the exchange risk. To explain that with an example, assume an investment achieved 20% as a net income in a foreign country, and the currency of that particular country depreciate, in other words, decreased in value, let's say by 5%. Then the real income is decreased by the same percentage, which means here that the real net income will only be 15%, not 20%. The effect of exchange rate on the foreign investment can be calculated by these two equations. First, home country return relative equal to the foreign country return relative multiplied by current exchange rate divided by initial exchange rate. Or the second equation, 1 plus home country return equal to 1 plus foreign return multiplied by the current exchange rate divided by the initial exchange rate. Let's take detailed example to see the effect of exchange rate in two different scenarios. Let's assume we have an American investor interested to invest in Mexico. So here the home country is United States of America and the foreign country is Mexico. Let's assume that the initial exchange rate was $0.2 per peso and the exchange rate after 1 year is $0.22 per peso. The investment return was 12% in peso terms, so the return relative will be 1.12. The return relative for the investor, which will be calculated in dollar as it's the home country for the investor, will equal to return relative in pesos multiplied by current dollar per peso divided by the initial dollar per peso, which is 0.22 divided by 0.2 multiplied by the return relative, and that equal to 1.232. This means that the US-based rate of return is 23.2%, despite that the original return was only 12%. We can conclude here that if the home currency depreciates, then the foreign investment value will increase. Let's assume now the opposite scenario, where Mexican investor interested to invest in USA. So, here Mexico will be the home country and USA is the foreign country. For the same exchange rates mentioned earlier, but presented in terms of peso. So the initial exchange rate is 5 pesos per $1. The exchange rate 1 year later is 4.55 pesos per dollar. And the investment return is the same as 12% in dollar terms. And the return relative in this case is also 1.12. This will result in return relative of 1.0182, which means that the rate of return is 1.82%. So despite that the original return is 12%, but the home country return is only 1.82%. We can conclude here that if the home currency appreciates, then the value of foreign investment decreased. From this example, we can say that the strengthening foreign currency, which means weakening home currency, is good from the home country investor perspective. However, a strengthening home currency, which means weakening foreign currency, can lead to lower returns.